Hello, and in this video, I want to show you what is meant by owner financing, seller financing, seller carrybacks, land contracts, wraparound mortgage. Basically, I'm going to walk you through this example so you could see what all this stuff means. It's a fancy way of saying this right here. The seller gets interest payments back for their equity, as opposed to in exchange for giving us the right to buy on terms, in exchange for the seller giving us the right to buy the house on terms, or giving us a little time in order to buy, 2, 3, 4, 5 years to buy, they want to get paid interest for their time. They're extending us that time. So let's walk this through. There's different terms: land contract, wraparound mortgage, trust deed, and all this other stuff. But the bottom line is this right here. The seller is going to give us a little time in order to pay them off in full. Let's say they have a house that's worth $300,000. They've been trying to sell it for 5 months. It has not sold. And they say, well, you know what? I'm willing to owner finance. So when we say owner finance, that term kind of confuses folks. Owner finance meaning essentially it's kind of like they're loaning their money out. And the seller might not have money, but they have equity. And I'll show you here this right here. They have equity that they're loaning out to us, giving us the opportunity to buy over time, as opposed to, traditionally, go get a loan, give them $300,000 from the loan, and then get them cashed out. No, it's a delayed cash closing, so the seller might want to get compensated for that. And I'll walk you through this process. Now, owner financing, again, you got different terms: land contract, wraparound mortgage. Basically, the seller is wanting to get interest for their equity. Now, let's walk you through this here. The price of the property is $300,000. The seller says, okay, I'll take $30,000 down, 10% down. Now there's a 30. You put down the 30, and there's a balance left of $270,000 of equity. House is worth $300,000. We put down 30. The balance is left to $270,000. Now the term is the balance of the $270,000 will be paid back to the seller as follows. Let's say the seller wanted a 3-year balloon. I can't go no longer than 3 years, right? So what we do is we give the seller a 3-year balloon. Let's say the seller wanted 4% interest. At today's current rates is about 4.5%, but anyways, 4% interest, and that comes to $1,938 and some change. Now we're going to walk through that on the next page. Now here is my mortgage calculator. Basically, what you have is the exact same terms when you go into the, let me go back here. 370 minus the 30 equals 270, or excuse me, the 300 minus the 30 equals 270 left. And that is what the seller wants his 4% interest on. So now when we go back to the calculator, the value of the house, 300. The loan balance left over, $270. What the seller's rate? 4%. Length in terms. Now this is and I'll show you the amortization table down here later, but basically mortgage companies generally use a 30-year amortization. Some use 4 if you want the payment to be lower. But anyways, the 30-year amortization table. Now the 3-year term that we have here, the 3-year balloon, right, is what we put over here. So when we go back to this page, the balance of $270 will be paid back to the seller in 3-year balloon at 4% interest. Payments in the amount of $1,938 and some change. And so the seller's payment will be $1,938. The total interest. Now, why would the seller finance? Well, it's the same exact reason that the banks finance. They give you, if you have a house that's worth $100,000, the seller, the bank will loan to you. Why do you think the bank do this? The bank does this because they're going to get interest. In 3 years, this seller will get $31,000 in interest. Those payments of $1,900 a month, I'm going to show you how that breaks down. Let's go there. Now, the payments break down. Now, yeah, this is principal, interest, taxes, and insurance included. Now, if it was just principal and interest, that'd be that. But we pay taxes and insurance when we do, land contract. You can negotiate all that actually, but let's just, in this case, let's say we pay the full total amount. The seller's interest that will be paid to him over the 3-year term will be $31,500. That's why they would finance. So when the seller says, how much interest am I going to get? That's what they mean. The principal pay down, now we paid $30,000 up front, so there's $270 left. So when we go down here, we will see 3-year term, that's 36 months. And that is what's left in principal to the seller when we are after the 3-year term, if it goes 3 years. You see? So when you look up here, we go up here and scroll right here. Oops. Let me go down here a little bit. There we go. When you look at the payment or the interest rate, or excuse me, I'm sorry, the interest due and the payment due. The whole payment is the $1,900 or something. But the payment, actually, this doesn't include tax and insurance, that's right. But the payment, this is just principal and interest. The payment, principal, and interest, as you see right here, PITI, or PI. This is PITI with taxes and insurance. Usually when you're doing a land contract and stuff, the seller, the owner will pay the taxes and insurance. All that can be negotiated, but let's not go into all that. The point is the PI, the principal and interest portion of the payment of this $1,289 payment, interest is $900, and then the rest is principal. So what's the benefit to the seller is that the seller will get $31,000 in interest, just as a bank will get interest. That's why they give you and me 0.5% or 1%, and they loan our money out at 4%, 5%, whatever the interest rates is right now. They get in low and give your money out high. So that's how it works when it comes to owner financing. The bottom line is that the owner wants to obtain some equity, some money for the equity. They want interest for the equity. Lease option is just pretty much straightforward. You rent to own. The house is worth $300. You put out $30, and whatever's left over, But when it comes to owner financing and land contract, you put in the specific terms. It's essentially all owner financing. Lease options and land contracts are all owner forms of owner financing. But this is more of a specific, because the seller might ask the interest. What's my interest? What's the term? 3-year balloon, that's your term. Interest, your term, and your what you're going to get as cash. So that's what the seller's looking for. How much am I going to get my bottom line? If I get 4%, how much do I get? Boom, $31,000 if the term goes to full 3-year balloon. Our goal is to cash them out 1.5 years into the deal. But if it goes a 3-year term, that's what the seller will get in interest with a balanced, a balanced still owed principal. The outstanding balance is still $255 of principal. However, the interest that has been paid is what the seller is usually looking at. If they're a sophisticated seller, they want to know, hey, how much interest am I going to be paid? So hopefully this video has helped you to understand more about owner financing, and that is what we're looking to do, and that's what the seller is usually looking at. Okay, have a good one.